Yeah! Coffee time. Just making a cappuccino. Yeah! Let's go.
Cue tracks.
Yeah. I gotta move. Give me the juice. All right, let's get going. Comment allez-vous? How are you? You having a wonderful day? Cool. Let's get going. I got to move this out of the way. I got to move that over there. Got JOLTS coming up. All right, let's get going. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, my name is Wayne. Nice to see you. I salute you. Hey, we're going to do technical and fundamental analysis. We're going to get the news, but, we'll do whatever you want. Let me know how I can help. I'll let you be the boss. I am just a humble currency trader. Yeah. So, I don't know. You tell me. Scalp, spot, swing, trade, position. We can do it all. I have a macroeconomics degree. Talk about that. Fund manager, talk about that. Now I'm more interested in endowments. I want money to last longer than I can last. Yeah, how cool is that? Used to be a venture capitalist, used to be a high-tech entrepreneur. I worked in the nonprofit world. I worked at NASA. Yeah, so whatever. We can talk about all that kind of stuff. One of the things I wanted to point out is that Traders Way is a broker that I think is unique. It's an ECN. They have a business model that doesn't trade against their clients. YouTube.com/Forex.Today. Let's go to the live video that we're doing now. So to get to Traders Way, just go here. Resources for traders, investors. A trustworthy, ethical foreign exchange broker. They have Forex. They have futures. They have stock indices. They have energies, metals. That's cool, right? But what's unique, because many brokers have that, what's unique is they want you to succeed. They don't B-book you. They treat you with dignity and respect, and they want you to succeed so that you become a successful client that they provide a service to for years and years and years and years. It's symbiotic. If you're like, Wayne, if I click on that link, you're going to track me, make commissions on my trading. No, don't click the link. Just type in tradersway.com. I don't earn commissions. Okay, now somebody asked, Kendo says, Wayne, where does one sign up for your $80 tutorial classes? Well, it's actually many, 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 many classes. You go to investorbootcamp.com. Okay. Cool. So, what do you get? 100 hours of training videos, live trading groups, strong support community, charting and trading tools. Yeah, look at all this beautiful stuff. This is the one we're doing now. Cool. My pleasure, Kendo. There's free stuff, everybody. Free. 90-minute lecture on trading stocks, 90-minute lecture on fundamentals, more specifically, how to use global macro to create a risk-on or risk-off bias, including my first trading strategy 20 years ago that I developed on my own. Okay. More free training videos over here. Cool. Nice. All right, so let's coffee up. We got some JOLTS today. We got the JOLTS report. It's going to be very, very interesting. Let me bring that up just so you have it. Okay, that's a 10 today. And it shows how many jobs are available, which is demand, and how many people are available, that's supply. Hey, Adam, good morning. Adam's like, hey, leverage funds, largest short positions. Yeah. It's not who's right or wrong, it's the timing. Like, for example, the first time I learned that, Adam, I in particular, because I sat on a board with George Soros, when I got into the trading, investing, and money management game, I couldn't help but think about my past. And I'm like, dude, George Soros is a money manager. At the time, I didn't know anything about it. So, you know, I love to say that George Soros put his arm around me and said, son, let me teach you all the secrets of how to make money. Well, of course, he didn't do that, but that would be a great story. But so later on in life, when I got in the game, so to speak, I'm like, oh, snap, George Soros was in that. You know, that's what George does. And so being a more of a retail trader, I was very much focused on the here and now, the today and tomorrow, not next year, next quarter, or next year, next decade. I would kind of like, you know, when I read about George Soros, it popped out in the news. It stood out because of the association. And for about a year, or maybe even longer than a year, George Soros was shorting the dollar, shorting the dollar, shorting the dollar. But this was a period in which the dollar was long. And I remember thinking, well, how dumb he must be and how smart I must be, because I'm buying it and making money, and this idiot, George Soros, was selling. Well, of course, a year and a half later, the dollar was collapsing, and I realized he was just building positions. It was a timing difference. And of course, I had my pissy little retail trades, my mini lots and standard lots, and he's putting billions and billions and billions, and he takes months, if not years, just to get a position. And then the trend takes off, and he makes more money than I'll ever make in a lifetime. And you're like, ooh, there's the difference, right, Adam? Who's right and who's wrong? There is no right, because in the moment I was right, but in the long run, he was also right. And then it was my job to adjust and ride the wave with him. So anyways, today is JOLTS, and does it matter? Yeah, it matters. So in my intermediate macroeconomics class, my professor was currently at that time a senior economist at the Boston Fed, and he specifically brought up the JOLTS report, and we analyzed it. So the Boston Fed cares. Right? Foot, there he is. Oh. Mm-hmm. Just seeing if it mentions the class anywhere. Hang on. There we go. All right. I couldn't find it. All right. So here's my professor who taught me economics. He's specifically he brought, one of the things we studied was the JOLTS report, right? So anyways, here he is. This is the Federal Reserve Bank of Boston, right? So we're at the bostonfed.org. Senior economist and policy advisor. Dude, does he look like a tough son of a gun? Dude, this dude, he didn't mess around. Yeah, he didn't mess around. Senior economist and policy advisor to the Federal Reserve Bank of Boston Research Department. Okay, he's a macroeconomics guy, and of course focuses on labor. Okay. Before that, he served as chief economist for the Council of Economic Advisors, which means they advise the President of the United States. He was the chief economist for advising the President of the United States. Amazing, right? Yeah. he is also, right, in the Department of Economics at Harvard. And so he was my professor. Yeah, dude, he was a tough son of a... Yeah, he was a tough son of a gun. I'm telling you. For his exams, I would say 2/3 of the class got less than 50%. Oh my God. Yeah. So clearly didn't let you go easily, huh? Didn't make it easy, right? No, is that right? How not to run a country? Yeah. Cool. All right. So, so anyways, get ready for that, JOLTS. By the way, everyone in the day trading group and the swing trading group, we're meeting today at 4 p.m. to do the week on the street. And we're going to go back and look at all the important news events over the last 7 days and actually read the reports. Okay, let's go into the markets. This is a very big deal. In my humble opinion, very big deal. Okay. And moving averages are taking this down. It's very interesting. Oh my God. This was sort of what I said with this was the last fallback position before the Alamo. And the Alamo is a long ways away. I can't even get it onto the chart. I have to go out to daily and back out. And the next line in the sand is, 65? Holy smokes. Sammy's short at basically 74. Yeah. Well, what you're doing is you're riding the moving averages. Okay. Now you're saying 78. So what were you trading? 73.85. 73.85. Yeah, I suppose. Yep. 73.85. Yeah. There you are. Okay. Yeah. So, yeah. Cool. Okay. In particular, on a 15-minute chart, it's a little bit of an odd. You're either early or you're late. So I'm not sure your methodology for pulling the trigger. What time frame you were on? I think you used a limit order. Oh, a 1 minute. Ooh la la. All right, let's take a look at that. Wow, you're down onto the 1 minute. Okay, yeah. Well, if you're going to do it that way, that makes sense. Okay, double top. Okay, and then you do this, and your trade plan is now fib off the lower high. Yeah, so if you're doing it that way, yeah, that's exactly 66%, guys. Notice it's not 618. Mr. Wright, we're doing rotation right now. So watch yesterday's video. I think I described it pretty well. Where it's rotation, it's not a change in sentiment. It's a change in asset class. Okay. But anyways, guys, I made a big stink a couple of weeks ago about how stupid a lot of technical analysis is, even though I love technical analysis, what I said at the time is people worship their indicators. And I specifically choose the word worship. They give it this power and meaning beyond the math. Instead of focusing on the math, they focus on what? The meaning? The greater meaning of MACD? There is no greater meaning than MACD. There is no lesser meaning. It's just as math, right? So it's more like, I want you to use the tools as a way for you to make decisions, not for the tools to make decisions for you and you follow the tools. It's ass backwards, but that's how gurus sell you stuff. Okay? So anyway, so I laugh at the idea that Fibonacci has this magical power, and if you don't believe me, look at the patterns of the skin of a pineapple or the skin of a sea star, or look at how the branches of the Japanese cherry blossom. You know, all this stuff. So silly. And of course, no one's actually gone out and measured whether the skin of a pineapple grows in a Fibonacci ratio, but that's what they're told. And so anyway, so I changed my indicator to say 33, 50, 66, none of which are Fibonacci numbers. 33 is not a Fibonacci number. 50% is not a Fibonacci number. 66 is not a Fibonacci number. And they don't have a golden ratio. But it uses common sense of 1/3, 1/2, 2/3. And look at, mine is just as good, if not better, than a Fibonacci. So just, move away from the magic and move towards the math, if you will, the common sense. I want you to make trading based on common sense, but for that, you need to understand trading. 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 366. Yeah. Yeah, I didn't say get rid of your indicators, right, Greg? I said you use them to make intelligent investment and trading decisions, but don't follow them. There is quite a difference. Who's in charge, the microscope or the scientist? Okay. So anyways, yeah, all right, sweet. Cool. All right, let's start with the stock market. Yeah, and Richard says, also makes a point, technical analysis becomes a self-fulfilling prophecy. That's perfectly fine. Again, I don't say technical analysis is bad. I love technical analysis. I am a champion of technical analysis. Okay? Yeah, absolutely. But make sure you are using them properly, right? Anyways, I'm not going to talk about it anymore. I'm done. All right. Let's take a look at the NASI. Okay, if you're going to be a downward dog, if it's going to be a downward dog day, this is what it's going to look like. Today's bearish target is down here. Today's bearish sell zone is here. And we've already respected that, but we have failed at the lower low. So you better make a decision. Okay. Is it this or not? Someone has already sold it. So this is a follow-on. Yeah. Yeah, I only preach understanding. I'm not preaching one way is better than the other. I'm not preaching right or wrong. I'm not preaching good or bad. I'm not here to stir up an argument or start a revolution. I'm just trying to promote common sense. Cool. And I think that's okay. Okay, so bulls are thinking long, bears are thinking short. So let's how do I want to do this? I don't want to get rid of that. Let me do this in an odd way, but it'll work. Okay, we knew this yesterday, by the way. Yesterday. You should join our day trading group, everybody. When I say things like, we did this yesterday, well, we did this in the day trading group. If you're a bear, okay, this is the close, and then this would have been the trade. You would have had a trade in Asia, and now your stop's probably at break even, and you're hoping and praying that it stays profitable. That's all. All right, so I marked that sell zone. Let's flip this around. Indicators, bias pivots. Let's look at the bullish point of view. Bullish, because we know bears did exactly what bears are supposed to do. Okay. And now let's identify what bulls are supposed to do. And bulls, right around this number, which is, well, I didn't quite get that one right. There we go. That's where bulls buy. So I would propose, makes me want to say apropos. I propose that bears have already done what bears are supposed to do. Bulls are doing what they're supposed to do. And that's that. What is everyone else doing? I don't know. Does it matter? Can you see that? And being a macro trend trader, I would suppose down remains the game, although I know most people want this to be long. And I also believe that this is coming down, but it's not bearishness. It's bulls taking profit. I think there can be up by the end of the year, and I think there can be some down in the early part of next year. And I'm going to discuss this next week. By the way, there's still an opportunity to join the CIA. It's $2,400 a year. And you will get real-world business experience managing real money. Yeah, so you can claim that you have been on the advising and decision-making side of managing money. Okay? My money. Yeah. Cool. I have about, I don't know, right now I think there's about $13,000 in cash in the account that needs to be deployed next week when the CIA meets. And there's another 45,000 that's already deployed, already investments that probably needs to be rotated. So if you want, okay, if you want to manage money, does anybody here want to A, manage money, B, start a hedge fund, C, manage money for like an endowment or a nonprofit organization or a charitable group? Or you want your money to live longer than you and change the lineage, change the bloodline, change your bloodline, change your family's bloodline so that the future of your family name is associated with wealth or at least stability, that you can pull your, right? That you can change the future. Is anybody interested in any of that? This is what's going on. Not just become a millionaire, but die a millionaire. Anyone interested in becoming like a financial advisor, money manager, hedge fund manager? Okay? That's what this is all about. I will teach you to manage money so that your money lasts and grows forever. And we meet next week. Is the money real or is this a simulated account? I have an institutional corporate account at a major Wall Street firm. We will use this account currently with 50,000. Well, sorry, it's now 55,000. Statements will be provided as documentation. The objective of the council is to oversee the growth into millions, all the while protecting risk and volatility. I will show you that I have a ridiculously low level of risk. It's so ridiculous that it's unbelievably low risk. And it makes money. Like a printing press. So anyways, if you're interested in any of that, we are doing this. This is real. This is live. We're meeting, what is it, next Wednesday? We're meeting in about a week. Experience you can call work experience. It can go on your LinkedIn profile as you know how to manage money, and I will teach you. Cool. So there we go. One or the other. And even if this is down, I don't think it's out. But it is what's happening. And quite a while ago, I drew this. Remember this? This goes back now months. I drew this. I drew the retracement. I drew the expansion. I drew the retracement. And then I have the expansion further. Can we actually hit that? We don't have the narrative now, but possibly. Okay. Now, Richard says diversification helps reduce risk. Well, that's all it does. In fact, diversification means you'll never get rich because you're focused on reducing risk. So the problem is, if you want to make a lot of money, you have to take on risk. So if you have a lot of money already, you reduce your risk. So there's this trade-off, right? What if you can reduce your risk and then find ways to generate returns that don't add to risk. And that's all of a sudden you're like, that is it possible? Yeah, there is a way. And so, and this is what I'll cover next week with the CIA. I will show you that I'm going to make 10% next year no matter what happens. And my risk profile based on risk analysis tools, not of my own, but of outside third-party analysis, is my risk level is ridiculously low. It's stupid low, but I'm going to make 10% no matter what happens. And that, to me, is close to the Holy Grail. Now, the reason it's designed that way is I'm running my fund like an endowment. And I learned this. I wonder if I can find his name now. Financial, I don't know how I do it. I remember his name. Advisor Metropolitan Museum of Art, Harvard, and I believe that's his name. Let's put it all together. Let's see if I can find. Let's see if this is okay to bring up. Anyways, yes. I guess I can show you. Mott, so he's a professor. And so this is the class. I think it had a slightly different name, but I learned how to manage endowments. So now I'm teaching you how to manage endowments. Interesting. Sotheby's, huh? Interesting. But anyway, so he ran the endowment for the Met, the largest museum endowment in the world. So now I'm taking trading and financial management and combining it with sort of the risk profile of money that's supposed to last forever. Isn't that cool? All right. So anyways, plan A and plan B is set forth. We can go into a smaller time frame. And you either sell high or you buy low or you don't know what you're doing. I can't get rid of that. And that's for the upper one. So anyways, hopefully you can follow that. So Richard says, do we look for high income using dividend strategies? Well, there's a problem with dividends. Okay. So you have company A, we'll call it a value company. And then you have a growth company. Okay. Now, growth companies, you buy it because you have future profitability expectations. Now, they don't have a lot of profit now. Well, I should say it differently. They have profit, but they reinvest the profit into growing bigger, to capturing more market share and or producing new intellectual property. Peloton one day might sell you a $3,000 bicycle that has 2 tires. But they don't have that right now. You only get 1 tire. So maybe some future R&D. They'll invest that profit and see if that helps them increase their market share. Okay. Now, on the other side, you have value companies. These are big companies that can't grow anymore. They're so big that they're already everywhere. So what do they do with their profit? If you can't plow it into growing bigger because you're Coca-Cola and you're in every country in the world except North Korea, do you think the senior management are sitting around going, gee whiz, guys, if we could only get into North Korea, then we can make it big? Okay, it's a different game, isn't it? So what do they do with their profit? If they don't need to use it for growth, they could plow it into dividends. Dividends. Which means what? Profit minus dividends equals less profit. By definition, they're less profitable. Which means what? If the stock value, so now if we're doing price, so if price is equal to future profits, some sort of analysis of future profits, this one is less and this one is more because they're reinvesting all their capital into trying to make more money, future profits. Well, you don't get any of the future profits, but the valuation of your asset goes up because maybe in the future, the company will be worth more because they'll be more profitable and they can plow that profit back into growing even more. And they can buy their competitors and they can buy intellectual property and they can buy customers and they can buy marketing and advertising. They can do all kinds of things where all of this has already been done by the constituency on the left. These guys have already done all that nonsense. These companies are usually much older. If Google is the #1 search engine on the planet, what more can they do on the search engine business? There's nothing more that can be done. Oh, well, you can invest heavily into DuckDuckGo, and it's growing at 25% a year. Yeah, growing from 4 customers to 5 customers. Okay? You see? So you have to decide which one do you want. And so to answer Richard's question, so you just go for high income, right? Through dividend stocks. Well, there's a trap to that. But the answer is, yeah, okay. But you're not going to earn enough. It's not enough. It's a good start, Richard, but it's not enough. How much are the average dividends? 1 to 2%? Well, what about the companies that pay you 10%? Well, very often there's a dividend trap. Okay? Once again, because they're giving away 10% in dividends, holy smokes. Well, they're giving away, let's say, all their profit, which means they're not profitable at all because they keep paying you, which means the stock price could come down. But they could also be not just paying you out of profit, what if they're sort of enticing you to buy them because it pays a high dividend? What if it doesn't come from profit but comes from cash? It's almost like a Ponzi scheme where they're not profitable at all. They might be a company that is break even, but they have $1 billion in cash from previous profits, and they're just paying you this way. Well, they're actually now losing money, and you're getting paid 10% a year, so you're happy as a pig in, slop. But the problem is it is slop. And then you find out that they're sort of lying to you in a way because the senior executives all get paid by stock options, and they're trying to find a way to jack up the stock price above what it normally would be instead of trying to figure out how to run a company well. They're trying to sell you the dog food that they won't eat. You see? So that's called a dividend trap, and you got to be careful. So I don't have a problem with dividends, but if you lean too hard on dividends, the company loses 20% a year, but they give you an 8% yield. So you've lost 12. So careful. Okay. So the higher the dividend, the worse it actually is. Most profitable companies can only afford to give you a 2% dividend, 1.5% dividend, because they only have 5% to 8% profit margins. So how can a profitable company give you a 10% dividend? There's no way they have a 25% profit margin. Doubt it. That doesn't sound like a saturated, mature market, like a value company. That sounds like a growth company, but how could it be a growth company if it keeps giving all its profits away? So it's probably a siren, right? Luring you into the rocky shore for a certain financial death. This is the end. Yeah. I'm sorry, was that too much? Did we go too far? Was that too offline? Okay. Let me reset some of this. This goes back olden days. I'm going to mark it this way, but I'm going to bring it down like that, make it a little tighter. Yeah, but you can see, Richard, it's tricky, right? So you need to run a much more active portfolio to be an endowment, for example, and you need diversification because you need the low risk. But you need to make money. And you used to be able to just be passively invested. That didn't work, I think, after the 2008 crisis. And what I learned in Mott's class, by actually studying the investment strategies of multiple endowments around the world, in my humble opinion, those endowments, because they needed to make money at a time when the bond market, remember treasuries 5-6 years ago? They paid you zero. Remember that? So here I am studying endowments, actual endowment portfolios and their strategies from major endowments around the world, real money, real strategies. I'm looking at them and I understand what they're trying to achieve, the goals, right? And yet I see what they're doing and their goals and their strategies did not align. They had to take big risk just to survive, and it scared the bejesus out of me. I looked at them like, these guys got it wrong. And it made me think about what I do, my philosophy of money, which was the best part. It was one of the best classes, not necessarily because of Mott and his training, maybe. I'm not saying anything good or bad. I'm just saying it was a good class. But its impact on me and what I did with the information is I sat back and I'm like, well, what's my philosophy of money? Which is, whoa, that's a deep thought. And then I thought, well, what is their goal? What's their intent? And I realized there was a misalignment. The strategies, they turned desperate. And they fired, let's say, financial advisors because the long-only strategy died in 2008. The 60-40 portfolio died in 2008. So it didn't work after that. And then you couldn't buy treasuries because they paid you zero. So the only way you could hit your minimal acceptable performance as an endowment, because you got to run your museum. You got to live on the money, honey. Okay? You got no money, you got no art, you got no museum, and there you are. So then they turn out of desperation to hedge funds. Well, what do the hedge funds want to do? They want to hit the minimum performance, but they do it with risk. And so then I look at it and I'm like, well, that doesn't work either. And here I am. I've thought about it for years, and I think I know how to do it. And from what I've seen during the boom and busts of the last 6 months, it's working tickety-boo. Tickety-boo, you. Who? Okay? And I'm running my own money on the strategy. It's real. Uh-oh. I got the same text 4 times. Uh-huh. All right. Cool. Anyways, you see? Thank you, Jean-Guy. So anyways, amazing, right? So you can see, like, even today, I don't even know how we got on this, but you can get an Ivy League education by joining the CIA. You will learn how to manage money. For the price of, I don't know, 1/4 of one class at Harvard. 25% of one class. So if you need convincing, how about this? You can get a $100,000 education for $2,400 a month. Or, sorry, year. Yeah, anyways. That's too much. I know, but I'm trying to make a point. All right. Okay. This is important. So, technically, this is an uptrend. Technically, MACD is falling, but is above the waterline. Technically, you can see we got something going on here. And technically, we got something going on here. Okay, so you got that, but you got the up. And troublesome trucks. This is not an easy situation. And we got this low. And I'm going to mark this as the high. And yeah. Now, Dow has been outperforming because money has been coming out of NASDAQ and into Dow. And if you take the stock trading course, it's because of the beta. Okay, the alpha of the money managers is to exit, okay, and capture beta. They're giving up alpha, going for the beta. And yeah, it makes sense. So this one will be the least ugly of the three sisters for now. And someday, okay, the beauty queen will retake her crown. Huh? The Duchess of, what was her name? The Duchess of some New Jersey county. Richard says, we're looking for good value companies that pay a nice proportion of profits to shareholders. The problem, Richard, and this is what I was saying before, is it's not enough. You don't earn enough money. This is why these endowments, they couldn't earn enough money through treasuries, so then they had to take on risk somewhere else. And then that wasn't enough money, so then they had to take on more risk somewhere else. Like the example of if you invested relatively conservatively and made 4% a year, that's not enough. And you had to pay the manager to earn the 4%. So what's one way that you can, what's one strategy you can do to get this to 10% minus 2% for the fund manager so that the endowment collects 8% income? Okay? You leverage this 3x. Whoa, dude, you tripled your leverage? Yeah. Uh-oh. So what if you have a down year? You're negative 30? How do you make your... You just lost 30% of your portfolio? Whoa, whoa. Whoa, whoa. Whoa, whoa, hey now. Hey now, no, there's got to be a better way. There's got to be another way, right? But I found that these decisions, because these endowments need, let's say $20 million a year, and they have $3 billion or $10 billion or $8 billion, let's say $5 billion. They have $5 billion in cash somewhere. That's too much, right? Because then they still make $500 million. Anyways, they have... Next year in their budget, they analyze, income minus expenses. Income may be people from paying membership dues and buying tickets at the door. So there's your revenue. So you make $5 million in sales, but you got $10 million in expenses because you have staff, you have insurance, you have rent, you have other expenses that are variable. And so you're like, there's a $5 million shortfall. So you turn to your endowment. You see? And the endowment needs to, as conservatively as possible, and hopefully like ridiculously conservative, be able to provide the extra $5 million. Okay. You're right, Kendo. I'll give you one reason, Kendo. because we talked about this the other day. Wait, that was probably QuantBox. QuantBox subscribers have already done all this. So it's old news. Pound Aussie's okay. But the problem is, if you're just doing it now, you're too late. It's way late. It's stupid late. So, okay, bulls were buyers down here, and bulls are going to take profit here. And there might be a retracement and expansion later. And even if it happens now, it's dangerous because it's, it's just the timing of the trades are the issue. Now, you're going to say, well, Wayne, how did you know this was going to happen? Well, I didn't. Did you? I didn't. But the thing is, that's what your job is to do. To say, well, I'm pound versus Aussie, right? Now, one of the things, if you watch the, let me bring it up here, youtube.com at the QuantBox. At the QuantBox. If you go to the QuantBox, you can watch this one. And let me just leave it there. I discuss it here. See? Look, same awesome hair. Okay? You know how early I have to get up to give you hair like that? It's ridiculous. A beauty queen on the movie scene. Said, what you mean? Pound versus yen. Okay. Anyways, you can watch that in 108 minutes. Now you'll know. Haroon's lost it, huh? Happens, man. I get you. I feel like I have a responsibility for those that have gone bald. So many men of my age, they just get short haircuts. Yeah, I just actually had to trim my hair this morning. I did it myself because my front hair went to my lip. It's hard to tell, but yeah, past my nose, well past my nose. So anyways. All right, so what a lot of people will do now is they will turn to Pound Aussie and say up. And what they don't realize is it's bad timing. Okay. And it's those that are thinking differently, if you will, and they're measuring levels of support and resistance. Let's do it this way. And you are more interested in buying low and selling high versus finding something that's rallied for 3 days and then buy it. Really? You're going to buy it 3 days late? Really? That's your strategy. Okay. Let's see. I haven't looked at these today, but let's look at them. What you mean? I am the one who will dance on the floor in a round. All right. So this is one I picked on, was it Sunday? I think it was Sunday night, part of the day trading group. I'm pretty sure that's how it went down. And I got to zoom further out. A 15-minute won't work. Okay. Anyways, I'll have to zip in. All right. So what I said in the day trading group, I'm pretty sure, and correct me if I'm wrong, day traders, but I'm pretty sure we looked at this and there's definitely a downtrend. Or wait, or was this Angel? This might have been Angel's question. I'm sorry, guys. I just do too many. I'm constantly studying my charts, right? Yeah. I mean, imagine I'm spending all day, every day. I'm looking at my charts, analyzing them, and talking about them. It's a good way to stay involved, right? Anyways, my point for this webinar was a point that I made several days ago, which by definition could have been yesterday. I don't know. Again, I'm in front of my charts all the time. This is definitely down. But the wrong strategy is to sell it here. And that the way you use your tools is to say, this is a place for bulls, or let's say bullishness, technical bullishness. It may not be bulls, it just might be bears exiting for profit, and maybe they'll resume the downtrend later. Doesn't matter. My point is, this has been incredibly down for many days. And it's exactly the time to not sell it, because it's been down for many days. And your job is use your tools to understand and plan the change. So at that time was up, and now what you're supposed to be doing, now that it's up, you need to be planning, is it going to be coming down? You don't buy it because it's up. Okay? But you had to have a thesis of it fell too far, too fast, it might be oversold, and we're definitely at or near a bottom. If you had that thesis, then what? Somewhere along the line, up, down, buy. Okay, up, down, buy. Up, down. Do you buy it? Maybe, but you should now realize, everybody, that that is now vulnerable this way. And you're like, that's so frustrating, Wayne. No, it's not. It's frustrating because you're not doing it right. You need to be thinking about this before it happens. You need to be thinking about this before it happens. And then you need to set up trade plans like, would you sell here if something like that occurred? And are you going to analyze the distance from here to here relative to the distance to here? And then set up shoulders and then ambush them this way. Wait, like this? Yes, like this. Remember, and now let me know, how many people here remember this just from recently? I don't remember which group I did it, whether it was here or a day trading group or a swing trading group. I don't know anymore. Maybe it was a quant box presentation. I don't know anymore. But we talked about a double bottom. I think I said, what if you only traded double bottoms with 1, 2, 3s? Double bottom. Great. Zoom in. Okay, there's your double bottom. 1. Okay, double bottom is the 1. Higher high is the 2. Higher low, and I even have it drawn. Remember, I drew this. Remember, a box in a box? There's your 3. Gone. Was that yesterday, Kendo? And I said, if you only did that, over and over again. There's 9 other strategies you never get, you'll always miss. But this is the one thing you did, right? 60% of the time, it works every time. And I think I did the Sunday on this pair, and I drew the white box and everything, and like, it's way down. Good. We should plan to buy it, or at least analyze it for a buy. Okay? Can anybody else confirm this? Kando said yes. Favor says weekly and daily. Okay, so that's cool, Favor. I'm good with that. Favor, I would say that you're more of an investor, and I do appreciate that. In fact, I actually talked about that yesterday in the day trading group, I think it was. The idea of investors and traders can't talk with each other. You know, oh, you're a trader. You just trade volatility and market timing. Well, I trade the long-term macroeconomic trend. No, you need to be able to do both. Okay? I want you to be able to understand the George Soros strategy. And I want you to understand a shorter time frame to that, like a trader. So in the CIA next week, we will analyze and discuss the exact same way George Soros would discuss potential opportunities and threats with his team. We will have the same investment strategy discussions that Ray Dalio would have at Bridgewater with his team of traders and investors. Remember, they're not just day traders. They're actually looking at strategies aligned with changing market conditions. We will act and behave exactly the same way, have all the same discussions, look at all the same data, and make decisions, but then we have to implement them on very small time frames. But not minutes, but months and quarters. Okay? Oh, right on, King. Yeah, not everybody loves him. In fact, many people hate him. I have a feeling they don't understand him. Not like that I have a deep understanding, but it's more like, I mean, look, people are going to quote reflexivity and all this kind of stuff. I'm like, dude, okay, wait. Before we get into all this stuff, you have to understand what he's doing. You have to understand why he's doing it. And if I can lend anything, like I haven't read any of his books or anything like that, but I am one degree of separation closer than most people, right? I might actually have it right here. Oh, I might actually have it here. How many degrees of separation, right? Do I have it here? No, I don't think it's here. Oh, I do. It's jammed in here. Okay. I have the annual report. Is this it, or is this the... No, that's not the annual report. It's a brochure. Boy, I know some people that would be very interested in this. Let's see if the annual report is here. Is this it? Yeah. Annual report from 1994, 1995. Yeah, I remember that too. Sorry. Going on a little memory trip with myself. Sorry. And, all right. Okay. Oh, I don't know if I can do this. I have to shut this. And I can't see. How old, huh? What an old man. All right. Webcam. Okay, there's, on the annual report, there's George Soros. Okay. Look, there's the chairman of the board. Not chairman of our board. But he was the CEO of Arthur Andersen, right? You guys remember Oliver Crom, CEO of Dale Carnegie? Right? Former Secretary of Commerce for the United States government. And where? Oh, wait, it's that hand. Okay. And I got to go over, got to go over here somewhere. I can't see. Oh, look I was just hanging out with Jeff the other couple of weeks ago. This is the youngest guy ever to run a mutual fund. Where am I? I don't remember where I am. I don't remember. Do you see me anywhere? I don't see me anywhere. Hang on, I gotta look now. Where am I? Oh, there I am. I'm on the edge. There I am. Look, same ridiculous hair. Same ridiculous hair. Anyways. Look, some of these people I just hung out with recently. It's kind of interesting. Sorry. Yeah. Yeah, sorry. Cool, dude. Some of these people are like... Anyways, cool. So anyways, yeah. Look, I actually did it. All right. So, right, so you want to put both together, right? Both the day trader and the investor. And to look at this maybe differently, the investor is going to see that we're in a scenario for the euro that's dire. We might do one of these things, and that's next year. And we might do one of these things. Oops, that was supposed to be a different color. Okay. Which one? Well, there's this idea that Europe is going to slash interest rates significantly more than expected. QuantBox has this information, by the way. Visually. And we can tell you when interest rates in Europe will be cut. But then relative to, so let's call this, when will the ECB cut? Now, a few months ago, there was no cut expressed by QuantBox. But now, there is. And how is that relative to the Fed? Because we're talking about now the dollar. And how is that relative to the Bank of England? Yet alone Australia, but let's just do this thought. So the Fed might cut more than the ECB, and the Bank of England might cut less than the ECB. And therefore, you have directional moves. Oh, thank you, Kando. Okay. Now, Richard has an opinion. I don't have an opinion. I only have the facts. Richard. And Quantbox shows you this, by the way. Quite literally does this. Okay? So you can start to understand that this, even though it's bullish this week, remember, I drew all this stuff for you. Remember, look. Okay? But are you prepared for variations of this? And if you're aware of it, is it plausible you end up selling it later this week, even though it's been up for a day and a half, which we discussed 36 hours ago? So now it's up a day and a half. So now you want to buy it. Why? Isn't there a reasonable probability that this now falls for a year? And you're chasing this up because it went up for 24 hours. And now you're like, well, it must be bullish now. And then you get mad at me because then it sideswipes you and somebody sells it off the 521 weekly cluster at a yearly R1. And you don't see the freight train coming the other way. Right? So you're trying to find, through the use of your MACD or some other holy grail, the light at the end of the tunnel. It turns out the light at the end of the tunnel is a freight train coming your way. Boom. When you might just sell it today and be short until July. But you'll never know because you'll never try. Okay? Oh, I don't mean that as a bitch slap. It's just I'm trying to appeal to your subconscious psychologically. I want you to try. I want you to break all your old trading habits. Not that you stop them, but I want you to add the investing mindset to your trader mindset. I want you to add fundamental mindset to technical mindset. I want you to understand both the market and the economy. So what I'm doing now, of course, is talking trader psychology. I want you to be big. I want you to be in control. I want you to be confident. I want you to be ahead of the curve, not behind the curve. I want you to think forward, not look back. I want you to be happy. I want you to be rich. In fact, I want you to be better than rich. I want you to be wealthy. The book I'm writing is about how to stop being rich and instead become wealthy. If you're interested in that, join the CIA. I will teach you everything you need to know about going from rich to wealthy. If you want a job one day in the financial business, in particular in money management or wealth management or financial advisory, you should also join the CIA. So at least you get to see it actually practiced. You'll become an actual practitioner, not just someone spouting philosophy. And it's a job experience that you can lean on and say, well, you don't have a lot of money managing your own fund, but you have worked on a fund for 2 or 3 or 4 years that managed real money and that grew an account from 50 grand to $1 million. And you can say, I was there every minute of it. You can do it like a Joe Biden. Well, when Obama was president, I was in the room when he made this decision. And then when that thing happened, well, I was in the room when Obama handled the situation. Oh, and when we tried to like do Obamacare and get that passed, well, I was in the room for that. Oh. So now what? Yeah. Hopefully you could use the experience more wisely than just saying, well, I was in the room when the adults made the decision. Yeah. Right? So anyways, hey, life is great. Life is good. Life is beautiful. There's lots of challenges in the world right now, but our friendship and our relationship and our collaboration is one of the, the guiding lights in a world of darkness. So thank you for being you. Thank you for your focus and your drive. I like what we do. And a reminder, if you're in a day trading group or swing trading group at Investor Bootcamp, we are doing the week on the street, and we are going to do all the homework together that 99% of traders are unwilling or incapable of doing. We will do all of that together and build proper trading and investing habits by loving the work and not finding shortcuts. Can I get a link? InvestorBootcamp.com. Join the swing trading group or the day trading group. Yeah, just pay money. That's it. I don't care who your mama or your papa are. I don't care where you live. I don't care what school you went to or didn't go to. I don't care what religion. I don't care who you make love to. I don't care your age. Okay? You insert a credit card. I think it's fair. Cool. And by the way, it's not that much money, so super fair. All right, cool. I got to jump. We got an interesting day. The markets are open, so I got to go. But also remind yourself, at 10 o'clock, we have the JOLTS, baby. And there's some sensitivity to that. Okay. Awesome. Peace on earth. May the pips be with you. May your profits be above average. I wish you nothing but success and happiness. I will see you soon.